During the financial chaos of the early 20th century, when banks were failing and the economy was in turmoil, the United States needed a savior. This savior came in the form of a new institution designed to bring stability and confidence to the financial system. This video will take you through the origins and crucial functions of the Federal Reserve, America's central bank, and how it became a vital player in our economic landscape. The birth of the Federal Reserve. As the nation grappled with financial instability at the dawn of the 20th century, the American banking system was on the brink of collapse. Bank failures, panic, and economic turmoil were commonplace, creating an environment ripe for reform. The lack of a central authority to manage and stabilize the economy meant that the United States was at the mercy of unpredictable financial shocks. This era of uncertainty underscored the urgent need for a more reliable and effective banking system. The turning point came with the Federal Reserve Act of 1913, a landmark piece of legislation that would forever change the landscape of American finance. Spearheaded by President Woodrow Wilson, the act was a product of intense debate and collaboration. Senator Carter Glass and Representative Robert Latham Owen were pivotal in crafting the legislation, which aimed to bring stability, regulation, and liquidity to the financial system. The Federal Reserve Act created a central bank with a structure designed to balance the needs of the country. It established 12 regional Federal Reserve banks, each serving a specific area, and introduced a centralized board of governors in Washington, D.C. This new framework was intended to provide a more responsive and controlled approach to managing the nation's money supply and financial stability. Regardless of its promising start, the Federal Reserve faced immediate challenges in its early years. The institution had to navigate through the complexities of establishing its authority and operational procedures. Early adjustments were necessary to refine its policies and improve its effectiveness in managing the economy. These initial struggles were a testament to the difficulties of transitioning from a fragmented banking system to a more centralized and regulated approach. As the Federal Reserve evolved, its role in American economic life became increasingly significant, addressing the very issues that had driven its creation. The journey from its troubled beginnings to its current status as a cornerstone of the U.S. financial system highlights the resilience and adaptability of this crucial institution. Structure and functions of the Federal Reserve. In the heart of the United States financial system lies an institution with a structure as intricate as the economy it serves. The Federal Reserve, or the Fed, is composed of several key components working together to maintain economic stability. At its core is the Board of Governors, based in Washington, D.C., responsible for setting national monetary policy and overseeing the entire Federal Reserve System. This board is supported by 12 regional Federal Reserve banks, each serving a specific district across the country. These banks gather economic data, supervise local financial institutions, and provide essential banking services to the government and the public. The Federal Open Market Committee, or FOMC, is another critical element. It consists of members from the Board of Governors and 5 of the 12 Reserve Bank presidents. The FOMC meets regularly to set short-term interest rates and manage open market operations, which are crucial tools for controlling monetary policy. Understanding how the Fed influences the economy can seem complex, but it revolves around 3 main tools. First, the Fed adjusts interest rates, which affects borrowing and spending by individuals and businesses. Lower interest rates can stimulate economic activity, while higher rates can help cool down an overheating economy. Second, the Fed conducts open market operations by buying or selling government securities. This action impacts the amount of money circulating in the economy and helps control inflation. Finally, the Fed sets reserve requirements, which determine the amount of funds banks must hold in reserve rather than lend out. These measures collectively help steer the economy towards stable growth. Beyond its role in monetary policy, the Federal Reserve also plays a crucial part in overseeing and regulating banks. By setting standards and conducting regular inspections, the Fed ensures that banks operate safely and soundly. This regulation helps prevent financial crises and protects the stability of the entire banking system. Through these functions, the Fed works to create a reliable and secure financial environment for everyone. Major historical events and impacts. In the midst of the Great Depression, a dark chapter in American history, the Federal Reserve faced one of its most daunting challenges. As the stock market crashed and banks failed, the economy plunged into severe hardship. The Fed's initial responses were criticized for being too cautious, but as the Depression deepened, it became clear that stronger measures were needed. During World War II, the Federal Reserve played a crucial role in financing the war effort and managing wartime inflation. The Fed's actions during this period were pivotal in supporting the nation's economic stability and ensuring that the wartime economy could function effectively. Fast forward to the 1970s, and the United States was grappling with a new economic dilemma: stagflation. This term, which describes a combination of stagnant economic growth and high inflation, presented a severe challenge. Under the leadership of Paul Volcker, the Federal Reserve took bold steps to tackle this issue. Volcker's approach involved sharply raising interest rates to curb inflation, even though it led to a period of high unemployment and economic pain. His strategy was not without controversy, but it eventually succeeded in bringing inflation under control and restoring economic stability. The 2008 financial crisis marked another significant test for the Federal Reserve. As the housing market collapsed and financial institutions teetered on the brink of failure, the Fed took unprecedented actions to stabilize the economy. One of the most notable measures was the implementation of quantitative easing, a policy where the Fed bought large quantities of government securities and mortgage-backed assets to inject liquidity into the financial system. This unconventional approach aimed to lower interest rates and stimulate economic activity. The Fed's swift and bold responses helped to avert a deeper recession and set the stage for the gradual recovery that followed. These actions demonstrated the Fed's critical role in managing severe economic disruptions and its ability to adapt to new challenges. The Fed's role in the modern economy. In today's economy, the Federal Reserve's role has become more intricate and influential than ever before. With a vast toolkit at its disposal, the Fed uses various monetary policy strategies to guide the economy. Recent years have seen the introduction of unconventional tools such as forward guidance, where the Fed communicates its future policy intentions to shape economic expectations. Additionally, the Fed has continued to use interest rate adjustments and open market operations to influence borrowing costs and liquidity in the financial system. These measures aim to manage economic growth, control inflation, and stabilize the financial system during periods of uncertainty. Central to the Federal Reserve's mission is its dual mandate: to promote maximum employment while maintaining stable prices. This balance is crucial for ensuring a healthy economy. When the economy is booming, the Fed may raise interest rates to prevent inflation from rising too quickly. Conversely, during economic downturns, it might lower rates to encourage borrowing and investment, helping to boost employment. The Fed's challenge is to navigate these conflicting goals, making decisions that will support both job growth and price stability. Despite its efforts, the Federal Reserve faces ongoing criticism and challenges. Some argue that its policies can lead to income inequality, as low interest rates may disproportionately benefit wealthier individuals and large corporations. Others worry about the long-term effects of policies like quantitative easing, which involve pumping large amounts of money into the economy. Additionally, the Fed's decisions are often scrutinized for their timing and effectiveness, as its actions can have far-reaching consequences. Balancing these concerns while fulfilling its mandate continues to be a significant challenge for the Federal Reserve in today's complex economic environment. Since its inception over a century ago, the Federal Reserve has continuously adapted to the changing tides of the economy. Its decisions have ripple effects that influence every aspect of our financial lives. How do you think the Fed's policies will shape the future of our economy? Share your thoughts in the comments, and if you enjoyed this deep dive into the Fed's history, don't forget to like and subscribe for more content. Let us know what topic you'd like us to cover next.